Welcome back to the Talking Hedge's 8-part cannabis business plan, where we go through from A to Z on how to start a cannabis business. Part 2 is when we went into the target market and demographics of who you were going to sell to. Then part 3, we dove into category sales and the price, certain marketplaces, kind of help you decide when to sell, what to sell. And today we're going to talk about investing. So from a CFO or a controller standpoint, if you're going to issue debt or if you're going to issue equity, a lot of people initially were doing convertible notes. That's changed. So we're kind of going to go over what the landscape would look like if you were public and what the landscape looks like right now when issuing debt or equity before we get into the pitch deck. Because before we get into part five is about pitch decks and investing. Before we get there, you need to know exactly what to issue, equity or debt. So that's what part 4 is coming up.
It's only entertainment.
Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business podcast. We're going to start off first by talking about the recent development with a shift in the way that equity and debt are issued. There's been a significant shift, as a matter of fact, in the way that debt issuances have occurred, kind of transitioning from equity-linked debt to straight debt with no equity linkage. Basically, what that means is when the cannabis industry first started, it was the majority of investment you would get is from a convertible note. That's a debt issuance that turns into equity when certain milestones are met. Until then, it's a personal liable debt. That shift away from that is kind of reflecting the industry's growing maturity and profitability, also reflecting some FOMO. In the early debt days of 2018, nearly all cannabis issues were convertible notes. Many issues had additional attachments. There were warrants to achieve total coverage of over 100%. And then in 2020, when a lot of these U.S. multi-state operators became EBITDA positive, that's earnings before interest, taxes, depreciation, amortization. As soon as their earnings became positive, issuance of straight coupon debt became a thing. So that we saw a $300 million Curaleaf deal in December 2020. Shortly after, there was a $100 million and $120 million deal by Cresco and TerrAscend. And then most of the top MSOs, including Ascend and Air, Cresco, Curaleaf, Jushi, TerrAscend, Trulieve, Verano, they've all completed straight coupon issues of $100 million plus. And then that rate is only 8 to 10%. It was at 40% at the very beginning for those debt issuances. It's come all the way down to single digits, which is, again, a huge kind of marker for maturity in the marketplace. Part of that is a sign of the times, and with the economy right now, credit market wants a lot of yield right now. There's not a lot of opportunities. There is some differences in things that are going on right now, especially with the high commodity prices and inflation. It's definitely a changing market. So in the next lesson, level 5, we're going to talk about the pitch deck and exactly what that ask slide looks like, whether you're offering equity or debt. Right now, it seems like the market is ripe enough to just offer either straight equity or straight debt without a convertible note, which is much, much different than before. Let's look at the market as it is still right now, especially with inflation. We're going to talk about how investors are looking at it from the outside in, kind of give you a different perspective. This will also help you if or when you decide to go public, what it's going to be like as a publicly traded company. So kind of give you a little background. During my career in finance, I was hearing a lot of investors that were talking about vice stocks or sin stocks and how they were outperforming a lot of the blue chip stocks during a market correction or recession. So sin stocks generally refer to shares of public companies whose business is considered unethical or immoral or unsavory. And traditionally, the term's been applied to alcohol or tobacco, gambling, and defense. And now that cannabis stocks are included in this segment, I was curious if more investors should be seeking alpha in sin stocks. So as a reminder, alpha is what gauges the performance of an investment against a market index. And in order to get some more clarification on the subject, I wanted to reach out to an expert, a guy named Larry Swedroe. So he wrote an article about sin stocks and expected returns. So I reached out to him asking for a little conversation. And according to Larry, sin stocks are considered to be fairly recession proof. There's a reason for this. People drink, smoke, gamble in both good times and bad. And while most of them view their own sins as discretionary, one theory for sin stocks' higher return is that they're more profitable and less wasteful with investment. It's due to the difficulty in the sector to get money. And when it comes to raising capital, so many companies don't tend to waste it. Now, he said this before COVID, before the lockdowns, before all of that. And he goes on to say that sin stocks are considered defensive. They tend to remain fairly stable under difficult economic conditions. They tend to suffer only when economic conditions are so bad they impair consumers' ability to spend. However, consumers typically revert back to their vices once the economy improves, and they tend to spend aggressively during bull markets. I think we're already starting to see that, people kind of cutting back because of the inflationary pressures. But once that's alleviated, they're going to dive all back in. We kind of saw that once people got some checks, stimulus checks, kind of came all into cannabis. When they're looking at price discovery, prior to my research on sin stocks, I was under the impression the reason for the above market returns was due to the demand for the product as being inelastic. And then after further research, sin stocks in part are systematically underpriced because of institutional investors' inability to buy them due to sin clauses, as well as those who lean towards the side of social responsibility investing, or SRI, as well as environmental social governance, or ESG. These investors express their values through their investments and believe sin could benefit from monopolistic returns, or maybe those companies could face increased litigation risk for which investors are rewarded. But there's also a so-called shunned-stock hypothesis, which allows other investors who are willing to invest in sin stocks to earn a premium from their reputational risk. That means that socially responsible investors pay a financial cost when avoiding these stocks because of social and ethical criteria. In other words, if enough people avoid a group of stocks, then their valuations will be lower, which means the expected returns are now higher. On the other side of the coin, traders are utilizing the strategy of investing in sin stocks like cannabis companies to protect their portfolios during economic uncertainty. So sin stocks have a lot of benefits in addition to being recession-proof, generating strong and constant earnings, and having limited competition. Sin stocks also tend to have better value, predictability, and a higher alpha. Historical evidence from the performance of the stocks support the theory that sin stocks have provided significant higher returns than stocks in general. UBS, for example, found that the 50 largest sin stocks greatly outperformed the MSCI World Index over the last 43 plus years by about 5% annually. Although there's been a slide in performance over the last couple of years, could be a shift away from equities and more towards cryptocurrency as crypto and altcoins DeFi continue to gain in popularity. So what could investors expect to see if a wave of people started dumping shares as they flee other investment vehicles due to market downturns, recessions, depressions, or market corrections? We might see a repeat of what happened during the 2000-2002 downturn when the Standard & Poor's Casino Gaming Index gained 115%, while the S&P stock index plunged 47%. All the while, shares of tobacco giant Altria, then known as Philip Morris, more than doubled. The stock of Anheuser-Busch, the largest U.S. brewer, advanced 87%. In Larry's article, he cites the price of sin, the effects of social norms on the markets, which found that from the period of 1965 through 2006, sin stocks in 7 of the largest 7 European markets and Canada outperformed similar stocks by about 2.5% a year. So what do the expected returns look like? Investors looking at sin stocks should expect a premium, although it's possible sin stocks underperform because of the shunned-stock hypothesis. The shunned-stock hypothesis states that sin stocks will have a higher cost of capital because it would trade a lower price to earnings ratio, which provides investors with higher returns. Larry also mentioned during the interview that unless people stop sinning, the earnings would continue to be there as well as generate above market returns. However, he also said it's plausible sin stocks could suffer through a period where cash flows are overwhelming those higher returns relative to the price. So investors need to have long-term discipline, which you should have with any investment. Hopefully that gave you a good overview about where the markets are at in terms of where debt and equity and what that's going to look like from the inside as well as outside from an investor point of view. Next up, we're going to talk a little bit more about pitch deck investment as well as that ask slide that really kind of dives into how to ask for equity or debt. And we'll also put a link in the description for the playlist so you can catch all of this 8-part cannabis business plan from A to Z. With that, we're going to roll this one up. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.